Welcome to our 2024 market update. I have with me here Danielle Robichaud, the portfolio manager for global equities. Dan, to start the year, it felt like there was a lot of pessimism. We were worried about a lot of things, economic growth slowing because of higher interest rates, the impacts of those rates on the broader economy. But it seemed like with these great returns we've seen from the markets, from the equity markets in particular, it kind of defied that. So can you maybe just help us bridge that gap? What happened there?
Yeah, 2023 was actually a pretty good reminder that trying to time the market is a fool's game. So we started the year with broad concerns around inflation, like about the upcoming recession. And honestly, what we've seen throughout the year is pretty positive economic data. So we've seen inflation coming down throughout the year. The labor market has been pretty resilient, while softening but still strong. So that really give some confidence that the soft landing scenario would be possible and fuel that rally where we've seen equities returning double digits. In December, what we've seen is also the central banks or the Fed in the US really surprising investors with a much more dovish message than anyone expected. So really signaling the end of the hiking cycle, plus expecting some rate cuts in 2024. So that really added some fuel to the rally. We've seen all asset class perform really strongly in Q4.
Yeah, when central banks use the word dovish, which means they're getting a little more easy on the monetary policy, wanting to maybe decrease interest rates or not be as aggressive on increasing as maybe we previously thought. With Powell saying that they might be done here raising interest rates, we also saw bonds do very well, which is nice to see for investors as well. What did we change in the portfolios during the year or even during the quarter that you can highlight that's kind of led us to be able to have such strong performance this year?
Yeah, if we talk Q4 specifically, like I said, the market has been pretty strong, and the change or the dovish tone has really increased the risk appetite from investors. So growth sectors has been outperforming. So we've seen technology in particular really outperform, but also what we've seen is sectors that were seen as more defensive, so more recession-proof, like healthcare, consumer staples, utilities, have been under pressure and really underperformed the broad index. So what we've done is, from our perspective, is go where we find the best risk reward in each sectors, and that led us to take some profit, mostly in the technology sector, and reallocate into some of those sectors I just discussed. So healthcare, consumer staples, utilities, where we find just better valuation out there.
So would you say that the portfolios now are more defensive than they were starting in 2023?
Yeah, I would say so. Honestly, typically we don't try to predict too much what's going to happen, and we just tend to gravitate to where we see the best possible risk-reward profiles. Right. And as of today, market is really has a really high risk appetite and is willing to take more risks, and we see this as an opportunity to reduce the risk profile in our funds.
Yeah, it's been good to take some profits too, and some of the names that have done really well. Looking forward, when we think about where the market's going, as you said already, we're not trying to time the market. It's we saw last year that it's kind of a fool's game. But you mentioned how it feels like the risk appetite's high. We're becoming more defensive. So what does that mean for our predictions for this coming year? What are the puts and takes?
Yeah, so from our perspective, the market has been quite generous in giving the Fed the credit of soft landing scenario. So I'd say we remain a bit more cautious about the soft landing. So I think there's a lot of question marks around inflation still. There's deglobalization. It remains an inflationary theme going forward. And just with the recent comment from the Fed, we've seen interest rates coming down, the markets rally. So that leads to loosening of the financial condition, and that's going to offset some of the work the Fed has done. So I think that's something to keep in mind. And on the flip side, I think we still have also some question marks around the health of the consumers. In the US, what we've seen is that consumers have been willing to dip into their savings to keep spending going, but from our perspective, there's still some question mark around that sustainability of that. So I think there's risk on both sides. The market is willing to give a lot of credit to that soft landing scenario, which I mean, if history is a guide, it would go against all odds here. So I think from our perspective, it's a good time to be a bit more balanced and a bit more defensive.
Yeah, I think that makes a lot of sense, and I think just balancing those two things where you have, there's still lots of things that can go well, still lots of things that we think are exciting with the economy, whether it's the onshoring, the large mega projects, all these different things that we're seeing on the infrastructure side of things, but then balancing that with consumers and where rates are going. So I really appreciate you giving us some insight today, and I hope everyone else benefited from it as well.